If you're in the investment world, I mean, especially if you're focused on long-term accumulation, you definitely know the number one rule, dollar cost averaging, DCA. It's the foundation, right?
Yes.
Consistent investments, same amount, same time, every single cycle, no matter what the price is doing. And it's brilliant because it just takes the emotion out of the game.
It's the perfect autopilot for, the average investor.
Yeah.
But you know us.
We don't like settling for average.
Exactly. So our mission today is to dig into these documents you send over and explore what happens when we upgrade that autopilot. We're diving into something called Smart DCA. It's an optimization strategy that's really designed to improve your entry points dramatically.
Right. So we're moving from like the steady, reliable Honda Civic of investing to something with a bit more torque.
That's a good way to put it.
The goal isn't to be a day trader, but to adjust the size of your recurring investment in a systematic way. And without needing a crystal ball, it's all about being smarter about when you deploy your capital.
That's the crucial distinction. Smart DCA, it still respects that consistency of periodic investment, but it optimizes the quantity based on, quantifiable market signals.
Okay.
The aim is simple. Buy more when prices are low relative to the trend, and buy a bit less when they're running high.
Simple in theory.
Simple in theory.
Yeah.
But before we unpack the mechanism, given the advanced nature of this strategy, we have to start with the essential risk grounding. This is mandated by the source material.
Okay, let's set the stage responsibly.
Absolutely essential. We have to be perfectly clear here. The content we are discussing is provided strictly for educational and informational purposes only.
Got it.
It is not in any capacity investment advice, nor is it a recommendation to buy or sell any financial assets. Investments inherently carry significant risks, and it is vital to remember that past performance is not and cannot be indicative of future results. No responsibility will be assumed regarding potential losses or consequences from applying any of this information. Any investment decision you make must be based on rigorous personal research, taking into account your own unique financial situation, objectives, and time horizon. The investor remains solely responsible for their decisions and the resulting consequences.
That grounding is so necessary, especially as we move into the more technical zone. So, okay, the core challenge of classic DCA is that rigidity. Whether the S&P 500 is melting up in a phase of, euphoria or it's crashing during a panic, you put in the exact same $1,000.
Which means you are, by definition, purchasing fewer shares when they're expensive and more when they're cheap is the goal. But it's not always optimized.
Yeah.
Smart DCA looks to invert that outcome using logic.
Okay.
The system aims to always optimize your entries, to systematically purchase more shares at better prices, but without ever requiring you to step outside your investment cadence and try to guess the next peak or trough.
Okay, so we need a mechanism then. Something that defines cheap and expensive in an impartial mathematical way. This is the indicator the source material relies on, right?
That's right. And this is where the technical requirement comes in, and it's the slight lift required to switch into advanced mode.
Right.
To execute Smart DCA, you need a quantifiable measure of the market's normal value over a long period. The source material directs us to use a linear regression indicator.
A linear regression indicator.
Specifically, the linear regression channel, which you can find on many charting platforms.
Okay, so let's unpack the linear regression channel, the LRC. For someone who understands, say, a simple moving average, like the 200-day line, what makes the LRC superior for defining this normal value?
That's a great question. A simple moving average is, it's just the average price over the last X number of days. It's delayed. And it's very susceptible to market noise.
What do you mean by noise?
Short, sharp moves that aren't actually part of the overall trend. They can throw the average off.
Ah, I see.
The LRC is statistically more sophisticated. It calculates a straight line, a best fit line, that statistically minimizes the distance between that line and every single price point within your chosen period.
So it's like it cuts through all the daily, weekly, or monthly chaos to show the asset's true long-term velocity and direction.
Exactly. It's filtering out the noise.
I like that.
This statistical trend line becomes your anchor, your market's gravity point.
Mm-hmm.
The LRC doesn't just plot the center line, the normal value. It also plots upper and lower bounds, the channel, that show the expected statistical deviation.
Oh, okay.
So if the price hits the lower channel, that's statistically rare. If it hits the upper channel, also statistically rare.
I see. That makes the interpretation for Smart DCA pretty straightforward then. If the current price is significantly above this central line, The market is stretched, maybe showing some euphoria, and the asset is more expensive than its established trend says it should be.
And conversely, if the price is significantly below the line, that price deviation can be seen as an opportunity. The market is fearful, maybe panicking, and the price is statistically lower than its normal trajectory. The goal is to measure that distance from the center line accurately.
Speaking of accuracy, the source material gave some really specific settings for anyone who wants to plot this LRC. Can you elaborate on those numbers? Why those settings?
Yeah, the document specified two key settings for the LRC, a channel length of 300 and a deviation setting of 1.
300.
300. The channel length is chosen to capture a significant amount of history, roughly 300 trading days. That's over a year of data. In the example chart they gave, which spans from 2019 to 2025, using a longer length like that ensures that the normal value isn't swayed by a single quarter's performance. It reflects a robust, multi-year trend.
And the deviation of 1, what does that mean?
So that relates to standard deviation, which is a key statistical concept. Setting the deviation to 1 means the channel lines are drawn to include approximately 68% of the historical price action.
I see.
By setting it at 1, you're looking for deviations that are outside the typical routine market fluctuation. We are only interested in measuring the deviations that are meaningful enough to warrant an adjustment to our investment.
Okay.
Once the channel is plotted, the practical step is using a measuring tool on the platform to calculate the exact percentage the current price is away from that central line.
Okay, so we have the percentage deviation. Let's say the price is 15% below the LRC. Now we have to translate that cold mathematical distance into a warm, actionable adjustment to our monthly investment. How does the 3x rule come into play here?
The fundamental logic is that the further the price is away from that trend line, the more aggressively we should adjust our capital deployment. The source material defines this as the 3x rule. You take that percentage deviation and you multiply it by 3 to get your adjustment percentage.
Why 3? Is that some magic number, or does it represent an intentional level of aggression?
It's the intentional level of aggression. If a deviation of, say, 15% results in a 45% adjustment, that's 15 times 3, right? The investor is effectively deciding that for every 1% the market is statistically cheaper than normal, they're going to increase their buying power by 3%.
Oh.
Think of it as the leverage factor of the strategy. It's what prevents Smart DCA from being identical to classic DCA during volatility. It forces a strong response to statistically cheap prices.
But introducing a 3x multiplier also introduces some necessary risk management. I mean, if the market is down 50% relative to the LRC, the 3x rule suggests a 150% increase in your investment. That sounds like a fast way to run out of cash if the drop keeps going.
And that is the most critical risk management element in this entire strategy.
Mm-hmm.
The source handles it with, I think, excellent behavioral insight.
Okay.
When the calculation suggests a huge increase, like that 150% you mentioned, the material strongly advises setting a safety cap. The advice is to not more than double the DCA in case of a severe drop.
So a maximum increase of 100%.
Maximum increase of plus 100%.
So that 100% cap is effectively a critical guardrail against our own zeal. It ensures we don't, shoot all our powder too early in a deep drop. It's risk management disguised as a formula rule.
Exactly. You protect your capital by preserving liquidity for the next month and the month after that, because market bottoms are only clear in hindsight. Let's look at the concrete examples you showed from the source.
Right. Example 1, the massive buying opportunity. We reference a crisis scenario like the one we saw on the S&P 500 chart, where the price just plummeted relative to the regression line.
In that scenario, let's assume we measure a drop of negative 35% relative to the center line.
Okay, 35%.
We apply the 3x rule. 35 multiplied by 3 equals a 105.
105.
So that suggests increasing the DCA by 105%. However, because of that essential liquidity cap, we adjust the DCA by plus 100%. You double your normal investment for that period. You're maximizing your share accumulation when the price is statistically cheapest, but you still have enough normal capital flow remaining for the next 11 months if the drop persists.
And what about the opposite? The market has been relentless. The price feels high, and we're staring at an expensive valuation relative to the trend. How does this strategy enforce discipline when the instinct is often to chase the gains?
That's where the system really shines, by enforcing caution. Imagine the price registers a rise of plus 18% relative to the linear regression line.
18% up.
You apply the formula. 18 multiplied by 3 equals 54. So you reduce your DCA by negating 54%.
So you're still buying.
You're still buying, maintaining the DCA discipline, but you are buying drastically fewer shares because the market is signaling that this is a moment of statistical overextension. You save that capital for when the market inevitably returns to or below that normal value.
This truly automates the behavioral discipline required. It literally tells you to buy more when others are panicked and to slow down when others are gripped by euphoria. It replaces that gut feeling with cold, objective mathematics.
And that leads us perfectly into the trade-offs. What are the necessary burdens and limitations for gaining this optimization? Because this is not set it and forget it.
That's my main concern. Doesn't the requirement for constant monitoring, calculating the deviation, and then executing the formula manually, doesn't that defeat the simplicity that made classic DCA so effective for the average person?
It absolutely requires a higher level of discipline, and that's the second limitation. Regular monitoring discipline are non-negotiable.
Right.
Classic DCA is fully automatic. Smart DCA is not. Yeah. If you let emotion creep back in, if you see a dip and think, oh, maybe I should increase by 150% this month, or if you stop adjusting when the market feels volatile, you negate the entire mathematical advantage. It demands strict adherence to the rules you set.
And what about the inherent limitations of the LRC itself? I mean, it's based entirely on historical trends, but markets sometimes experience paradigm shifts, a global financial crisis, a technological revolution, something that just fundamentally changes the trend.
That's the first key limitation. Dependence on past trends. The LRC is purely statistical. If the market enters a long, sustained, irrational phase, either far above or far below that center line, or if a true structural shift happens where the long-term growth rate changes dramatically, the LRC might be biased or just temporarily ineffective.
Okay.
The market is ultimately unpredictable, and the LRC assumes the historical trend will continue to assert a gravitational pull. If that gravity disappears, the system might be temporarily out of sync.
So we're relying on the fact that market trends over the very long term are mean reverting.
Exactly. And the third and perhaps most vital limitation is the scope of the strategy. Smart DCA is a fantastic tool for optimizing entry price, but it's not a magical safety shield, does not replace genuine risk management.
It won't save you from a complete black swan event or if the underlying assets go to zero.
No. Diversification across different assets, different sectors, different economies, and diligent capital management remain the essential tools for limiting catastrophic losses. This strategy must be seen as a sophisticated complement to your overall risk framework, not a replacement for it. The source material is very firm on this. Continue your self-education and consult certified financial advisors before implementing complex strategies like this one.
That's a powerful distinction. Smart DCA is volatility exploitation, not volatility protection.
And the complexity of the execution is the price you pay for the optimization.
To quickly summarize the key technical nuggets for anyone ready to embrace this advanced strategy, Smart DCA uses the linear regression channel specifically with settings designed to capture multi-year trends as its normal value benchmark. When the price deviates, you use the 3x multiplier rule to determine the aggressiveness of your adjustment, and crucially, you maintain a plus 100% cap on increases during market drops to preserve liquidity and, well, your own behavioral resilience.
Which brings us right back to the human element. We know that fear causes people to stop buying during drops, and greed causes them to pile in at the top.
Of course.
So since the success of Smart DCA hinges on overcoming these two powerful emotional impulses, how might using a predefined objective technical indicator like the LRC, a tool that physically tells you when and by how much to deviate from your normal course, help the average long-term investor finally stick to their plan when their gut feeling is screaming at them to do the exact opposite? That psychological override is arguably the greatest benefit of this entire structure.